Welcome, ladies and gentlemen, to our program. So this is just a continuation on finance. We're still on the financial world. So the last video was based on the student versus business loans. So today we're going to talk on about mortgage. This example will be based in Europe. So the first point, I'm going to show the connection, first of all, between the interest rates and the collateral. Then the second one, I'm going to give the key elements of mortgage. Then the third one will be the types of mortgages in Europe, because this video will be based in Europe, but it can be used worldwide in all the continents. Then the fourth video, I'm going to touch on how mortgages works in practical, like in the real world. Then the fifth point will be based on the practical examples, practicality, as I like to give practical examples always. The sixth point will be based on the benefits of mortgages, the pro or the con side, the pro sides. Then challenges, like what happens if you don't pay, or what happens if you don't repay. That will be like the con side, the negative side. Then the eighth point and the last one will be based on the additional cost. Then after that, I'm going to give a quick summary at the end, just as we usually do in all the videos, to sum up really what we learn in each video. So are you ready, ladies and gentlemen? Tighten your belt and let's begin. So the last video is based on the student versus business loans, student loans versus business loans. So which one was the best? So we said like the government preferred the student loans. So they are ready to give the student loans with which are non-collateral, which means you don't need any security, you don't need any pledge, you don't need any backup really. But in the case of business startup, the government is serious. You need a collateral, you need a property, you need to pledge something valuable before you give in the rent or the loan. In the case of a government, it can be public loan or private financial, which means government owned, or private, it simply means individuals or companies or banks. In this case, we have like public banks and the private banks. Then after that, the video is simply based on the one after the student loan was based on the financial freedom, which is all about like budgeting, saving. I said saving is much better than spending. Then we have investment. Investing is far better than saving and spending at the same thing. So when I say spending, it's all about expenditures really, the way you spend. Budgeting is all about income, your cash flow, the inflow, the outflow, how the money comes in and the money which goes out. That's like budgeting really, can be done like after 12 months. Then we see like you can see the differences between the loan and interest rates. So in the case of interest rates, it's just a mechanism used by the government when in case of inflation or deflation or hyperinflation or stagflation, which simply means really to encourage or discourage people from borrowing money in the bank or any government institution where you can borrow capital or money. So ladies and gentlemen, let's start. Mortgage in Europe. I'm going to show it's always with practical examples. So a mortgage is a loan specifically designed for purchasing real estate, which means like real estate can be rental, anything really which is an asset such as a home or commercial property. All of those falls under the real estate. So in Europe, a mortgage functions as a secured loan that enables individuals to buy property by borrowing money from a lender. In the case of a lender, if you're lending money, you become the creditor. The one who borrows money becomes the debtor really. So you borrowing, you become a debtor. When you lend, you become a creditor in this case. So typically like a bank or a specialized mortgage provider. So the property being purchased serves as a collateral. In the case of mortgage, because this is a house, whatever we're purchasing, in the case of mortgages, the property is going to serve as a collateral, which means a guarantee, a pledge of security. In the case when you fail to pay, the lender will come and take the valuable property or whatever real estate in case to repay whenever you fail or default to pay the mortgage or the loan in this case. Which means if the borrower fails, the lender fails to repay the loan, the lender has the right to take ownership of the property through a process called the foreclosure. So if you or the borrower or the debtor fails to repay, then the lender or the creditor has got the legal rights to come and take all the property or the ownership of the property through a process called the foreclosure. So first of all, I'm going to look at the connections between interest rates and the collateral. In the case of interest rates, like a mechanism, which we said there, it can be the case of inflation, hyperinflation, or deflation. So inflation is just the rise of price through a given time or specific time. Hyperinflation is like the exaggerated of inflation, cases of inflation, like the price going up 50 times or 50% higher every month. That's like hyperinflation, exaggerate extreme side. Then deflation is like when the consumers or the customers have the fear to purchase something with the hope the price is going to drop tomorrow in the future. There's like deflation, which is the opposite of inflation. So the connection between interest rates and collateral. Collateral is just a guarantee, a pledge which you have to make something valuable in case to cover your loans. That's all about collateral. So lenders or creditors in this case often offer low interest rates for loans that are secured by collateral because the risk is reduced. But in this case, it is an exception because in the video which I did recently between the student loans and business loans, even though there's like 0 interest rates in the case of student loans, despite being non-collateral, the student doesn't need a property, does not need any private or business assets in the case to secure a loan. But if you have collateral, if you want to borrow, you take a loan in the case of business or mortgage. If you have anything really acts as a security, then they're going to lower the interest rates for loans that are secured by collateral because the risk in this case is being reduced. So this is like a guarantee, in the case if you fail to repay. So on the other hand, unsecured loans without collateral tend to have higher interest rates to compensate for the increased risk. So compensation is like they're really, in the case if you fail, they'll take something else in the case of your loan, something valuable really. So a mortgage is a secure loan where the house itself serves as collateral. So the house is like the real estate, which is a property, an asset. It serves as collateral itself in the case of mortgage, resulting in the relatively lower interest rates compared to unsecured personal loans. So the second one, going to look at the key elements of a mortgage. The key elements of mortgage. So the first one is like the principal, which is the amount of money borrowed to buy the property. So the amount of money you borrow to buy the property or the house, it is called principal. The second one is like the interest rates, the mechanism which the government use. So it's usually presented like in percentage. So the cost of borrowing, typically either fixed or variable. Fixed is like constant, variable is like changeable. So in the case of a fixed interest rates, it stays the same throughout the loan term. So if it is fixed, let's say 5% interest rates, it's going to stay the same until when you start repaying, you finish the repayment. There's like the fixed interest rates. Then in the case of variable interest rates, it's like fluctuates based on market conditions. So in the case of fluctuations, like up and downs, in the case of marketing, or variable goes up and downs. So when the interest rates goes down, you start paying the lower prices as well. When it goes up, the price also goes up. So in that case, you have like a fixed and a variable. So the third one is like the repayment period. In the case of key elements of mortgage, you have like the repayment period or term, which is usually between, let's say, 20 to 30 years, during which the loan is repaid with interest. So the period really depends on how much you're going to borrow. So the higher the price, the longer the years really in the case of repayment. So if it says, let's say, 20 to 30 years, it will be like the period in the case where the loan is going to be repaid with interest on the top. So the fourth one is like the down payment as well. The key elements of mortgage, like an upfront payment that is percentage of the property is price, often a 10 to 20%. That's like the down payment. Those are like 4 key elements of mortgages. So point 3 is all about the types of mortgages, because we're going to focus on in Europe, but it can be used in all the continents, Africa, America, Asia, Australia, all over the world. So I'm going to give the key types of mortgages just in Europe, based in Europe. The first one, we have like the fixed rate mortgage. That's the first one. So fixed rate, like when I say rates, all about interest rates. So the fixed rate mortgage is like we have the interest rates remain constant or the same for a set period. Let's say 5, 10, or 20, or even 20 years. So it will not change. It is predictable. For example, because I have to keep drawing some examples, practicality. Let's say in Germany, let's say a 10-year fixed rate mortgage allows borrowers or debtors to pay the same monthly installment for the entire term. So if it is fixed rate, it doesn't matter how much if it is how long, 10 years or 20 years, it just stay the same, the interest rates. So the advantage of fixed rates, like it is predictable, like in the case of predictability, Okay, it is predictable or certainty, and protection from interest rates fluctuations up and down. So when the price increases, it doesn't matter to you because yours has been fixed since the start or the beginning. So the disadvantage of that is like less flexibility or adaptation in this case if interest rates drop significantly. So because it is fixed, even when the interest rates drop down in the market, yours will just stay up the same one. So there's no flexibility, there's no adaptivity in that case. So the second one, the types of mortgage, of the second one is like a variable or adjustable rate mortgage. It can be like the ARM, adjustable rate mortgage. It's like the interest rate changes periodically based on the market conditions. So when the market fluctuations up and down, like usually linked to a benchmark rate like the Eurobor. I think there's in the Spain Eurobor. It's like EURIBOR. So example, like in Spain, variable rate mortgage often start with a fixed rate for a few years, then adjust annually according to the Euribor. Advantage of that, of the variable, is like lower initial rates. So initial is like the start. At the start of like lower initial, the interest rates is lower at the start, beginning. Then borrower benefit if rates decrease. So if there's a decrease in the interest rates, if you are the debtor or the borrower, then you start paying less than the previous amount that you started with. Let's say in London, in this case, there's like the advantage of variable. Let's say a quick example in that case. Disadvantage of a variable, we have given the advantage already, disadvantage as well, the con side, we have given the pro and the cons. So in the case of disadvantage of variable, it's like uncertainty. You cannot be certain if the price will go up or down, so it is like fluctuations. Uncertainty, payments may rise significantly if interest rates also increases. So if the interest rates goes skyrocket, then the payment also will increase like a simultaneously, really directly proportion. So the third one, types of interest of mortgage is like the interest only mortgage. It's only based on the interest. So borrowers only pay the interest on the loan for a certain period, let's say 5 to 10 years. Just pay the interest based on the of the loan for a certain period. It can be fixed maybe 5 years or 10 years. So example, let's say in the UK, United Kingdom, interest-only mortgages were popular before the 2008 financial crisis, like the Wall Street financial market crisis. Borrowers or debtors paid only interest for the first 10 years, reducing monthly payments as well. Advantage of interest-only mortgages like lower initial payments. Initial is like that at the start, the interest rate is lower. Disadvantage of that, like after the interest-only period, borrowers or debtors must pay both the principal and interest, leading to higher payments. In this case, the principal is like the money which you put at the start to buy the property or the real estate or the asset in this case. So the fourth one is like the buy-to-lend mortgage. The first type of mortgage is buy-to-lend mortgage. It can be, in this case, maybe in America, we can have like the first homeowners or buyers. You might get some advantage or some deduction because you're still the first home buyer or first home owner, something like that. So in the case of buy-to-lend mortgage, it's like designed for individuals purchasing property to rent it out rather than live in it. So if you purchase a property, a house, just to rent out instead of yourself living there with the family, this is you want to go with the buy-to-lend mortgage. So example, let's say in Ireland, a buy-to-lend mortgage requires like a larger down payment, sometimes 25 to 40%, because that is like buy-to-lend, you're not living there yourself. But if you are the one who living inside the house, you can pay only 10 to 20%. But because this buy-to-lend, you pay like a higher down payment, up to 25% to 40%. Compared to the residential mortgages. So in the case of residential, it's when you're living there, residing there in the house yourself. So advantage of buy-to-lend mortgage is like potential rent, income covers like mortgage payments as well. What if the tenant or the people living in your house there, what if they're paying, using the same rental payment to cover the mortgage payments? So they're the ones who are paying for all your mortgages in that case. But the only disadvantage here is just the down to payment. The price is higher, 25, the interest rates is higher, like 25 to 40%. Disadvantage of that is like the risk of not finding tenants or managing rental property. Disadvantage to you as the homeowner or the house. So in the case of rental, if the The tenant already knows they're the ones who are paying for you. There might be like a high risk on finding tenants, people like living in your house, or managing rental property. So if there's any damage, you are the one who have to cover all the damages and recoveries and the maintenance as well. So the fourth point, we're going to look at mortgages work in practice, the real world now examples. So let's say in France, because just based in the European Union, the EU, so in Europe, let's say in France, mortgages like in France often include both fixed and variable rates. So fixed is like constant, variables like fluctuations up and down. Like marketing varies with the marketing economy. So the French market is characterized by the long-term fixed interest rates up to 25 years. The higher the amount, the longer going to take to pay out. So for example, a borrower or debt in this case, purchasing a house in Paris with a 300,000 euros mortgage at a fixed rate, let's say of 1.8%, over 20 years would have a predictable monthly payment of around 1,500 euros. So you want to borrow like 3,000 euros mortgage at a fixed rate of 1.8% over 20 years. So you're going to predict really what you're going to pay every month. It will be like 1,500 euros a month, the amount which you have to pay over 20 years. So the second one would be like in Germany. Let's say Germans prefer long-term fixed rate mortgages as well, same as the French, with many opting for 10 to 15 year fixed rates or fixed terms. So fixed terms like the time to pay. So a family buying, let's say, a 400,000 euros home in Berlin may take like say 15-year fixed mortgage at a rate of 1.5%, which is not too bad. 1.5% interest rates, meaning stable monthly payments of about 2,000 euros a month. So in Berlin, you say you want to buy a house or mortgage of 4,000 euros. 15 years fixed interest mortgage at rate or interest rates of 1.5%, then your monthly payment, it will be like 2,000 euros a month payment in the case of a mortgage. That's how it works. So it's a loan really. Then the third example would be based like in Spain. Spain's mortgage market offers a variable rate mortgage, which is different from the fixed interest. The Spain of like the variable rate mortgages, often tied to Euribor. A person buying a home in Barcelona, let's say, might start with a fixed rate of 2% for the first year, switching to a variable rate afterward. So you start with the fixed, let's say, 2% interest rates, which is high, compared to 1.5 like in Germany, the one above, or 1.8 in France. So you start with the fixed at 2% for the first year. Then you're switching really to a variable rate, like fluctuating up and down afterward. So the borrower or the debtor benefits if rate falls, but face increased cost if the Euribor rises. So you benefit when there's interest rates fall in the market, but when the interest rates increases, in the case of inflation, then you are the one who's going to pay high cost as well. So if the Euribor rises, the fourth one will be based on the UK, United Kingdom, the fourth example. So in the UK, the 2-year or 5-year fixed interest like rate mortgages are common in the case of UK. So after which like the loan typically moves like to a variable rate. In the case of UK, you have to pay like a 2-year or fixed year like a fixed rate in mortgage. After that, then you can change to variable rates, fluctuations up and down. Like for example, someone purchasing a home, let's say in London, with a 200,000 pound, because there was a pound, 200,000 pounds mortgage might fix their rate, let's say at 2.5% for 5 years. Because just a short time, 5 years, the interest rate is also high, 2.5, compared to one in Germany to 1.5, and one in France was like 1.8%. In Spain, it was like 2%. Now in London, you have like 2.5% for 5 years, paying about 900 euros or 900 pound monthly, with the possibility of changing like payments when the fixed period ends. So you still have like possibility of changing payments when the fixed period ends. So when the 1 year or 2 years fixed is end, you can start changing like variable rates as well, fluctuating with the markets up and down. So the fifth point will be based on the practical examples. So I'm going to give a quick scenario. Let's say you want to buy a home like in Germany, valued at 500,000 euros. So you can provide a down payment of 20%, because it's not a buy to lend, or putting someone inside the house, or renting the house. You are the one who want to live in the house yourself. So you have to provide a down to payment of 20%, which would be like 100,000 euros a month. So you need a mortgage for the remaining 400,000. So if you want to buy a house, like in Germany, 5,000 euros, at 20% of that down payment, it will be like 100,000 euros. So you need a mortgage for the remaining 4,000 euros or 400,000 euros to make it 5,000 euros. So you opt like for, let's say, for 15-year fixed rate mortgage at 1.8% interest rates. So the loan term is also like, let's say, 20 years with monthly payments. So you have to pay all the money in the 20 years. 15-year fixed interest rates at 1.5 interest. But so you have the other 5 years, which would be like variable. So 15 years would be fixed interest mortgage or fixed interest mortgage at 1.5 interest rate or interest rates. Then the loan term is 20 years. So you have like 5 years on the top in the case of fluctuations, really. So monthly payment calculation, a quick one, like using a typical mortgage calculator, your monthly payment will be around, let's say, 1,950 euros in that case. So we're going to look at number 6, benefits of mortgages. So it's like the pro side, the positive side, the bright side of mortgages. Is there any benefit? So the first one is like ownership, really. So enable you to own property or real estate in this case, which is an asset, by spreading the cost over many years. So you have like 20 years coverage, 15 years, 10 years. So you own the property by spreading the cost over many years. But the problem is that the interest rates, so like spoiling. So in the case of appreciation as well, in the case of appreciation, like going up, the increases in price. So property values can increase, like providing financial gain as well. So if you finish your mortgage, maybe let's say in 2024, after 2 years or 5 years, let's say after 6 years in 2030, like the prices of the houses goes up or homes, then you'll be the one going to benefit really from get a profit, financial gain from that when you want to sell your house after 2 or 5 years. So fixed payment as well, the benefit. You like fixed rate mortgages ensure predictable monthly payments. If you don't want to uncertainty, you have to go with the fixed interest rates. So you will not really predict how much you're going to pay each month, like monthly payments. So the seventh one will be like on the seventh one, we're going to touch on the challenges, like what happens if you don't repay. In this case, it would be like the negative side, the cons side. So risk of default, in the case of default, we said when you are unable to pay or when there's a long delays to repay your loans, this will be like risk of default. So failing to repay can lead to foreclosure. So if you stop making payments, the lender or the creditor in this case may start the foreclosure process. So in the case of foreclosure, the lender or the creditor in this case takes legal action to seize and sell your home to recover the remaining loan balance. So if you fail to pay, it doesn't matter 5 years or 2 or 3 months, the lender or the creditor will come and seize the home, whatever you have. So they will have to sell your home to recover the remaining loan balance. So you lose everything, including the money you have paid for 2 or 3 months. So the interest cons is like the interest cost. These are like the challenges, the cons, the negative side. In the case of interest cost as well, like the long-term loans result like in higher overall interest payments. So because you're paying the interest on the top as well, like 15 years, 20 years, the interest keep going higher. Like you can borrow, let's say, if you borrow, let's say 3,000 euros in the 22 months or 24 months, like over 2 years, instead of just paying 3,000 back, you have to pay like 3,500 euros or almost around 4,000. So the lender or the creditor will benefit 1,000 on the top. So that is the meaning of interest rate or interest cost. The second one is the third one in the case of challenges is like the rate fluctuations up and down. In the case of interest rates, that's all about the rates fluctuations. Like variable rates mortgages can lead to unpredicted or unexpected cost increases. In the case of there's no certainty in this case because this variable changes up and down according to the market economy. So if there's a high inflation, then maybe the interest rate is too high. Then as the debtor, you're the one who's going to suffer. If the interest rate goes higher, then it will be to benefit, but with the disadvantage of the lender or the creditor. So the 8th point is based on the additional costs now. So in the case of mortgages, there's some additional costs. It's like the property tax. You need a property tax. If you take a mortgage, a home, the property in this case, it will be the house or real estate. So often included in your mortgage payment through an escrow account. You need the property taxes as well, included in a mortgage payment. The home owners insurance as well, you need that, like required by lenders, in this case they are creditors, to protect the property against damages or in the case of loss. You need a private mortgage insurance, the PMI, private mortgage insurance. If your down payment is less than 20%, so you say the down payment will be like around 10 to 20%, but if it is buy to lend, if you put in someone else in the house, it will go higher, like 25% to 40%. So in this case, the private mortgage insurance, if your down payment is less than 20%, you may need to pay the private mortgage insurance, the PMI, which protects the lender in case you default. In the case you default, like fail to repay your mortgage. So what can we say, ladies and gentlemen, about the conclusion in the case of mortgages? It's all about taking loan into the bank. It can be public, which is government backed, or private financial institutions or private banks as well. So in the case of loans, like there's some positive side, bright side, some negative side as well. In the case of mortgage, which is like secured, which means you have like to provide a collateral, a pledge, a security, a guarantee of something valuable for them to give you some type of loan, because this like in long term, which you have to repay like after 10 years, 20 years or 15 years. So in that case, the lender or the creditor need to have some type of security as well before they trust you with their money, or before they lend you the property, the real estate, the house in this case. So what can we say, ladies and gentlemen, in summary about the mortgage in Europe or all of the world, Africa, Asia, Australia, all of the continents? So a mortgage is one of the most common ways people finance the purchase of a home or house or real estate in this case. It provides a way to afford like real estate without needing the full purchasing price up front, without needing the full amount up front. So you borrow because you don't have the full amount. You borrow the money to complete there, so you start paying over time. So in Europe, like mortgages are a common way to finance home purchases, but the structure of mortgage can be fixed or variable. In the fixed, it is like constant, variable, fluctuates with the market, up and downs. And the type of loan, it can be like a residential or buy to let. In the case of residential, you are the one who want to live in the house. In the case of mortgages, buy to let is when you want to put tenant or to have people living inside the house. So whenever they're paying the rent, they're actually paying for you. But in that case, they buy to let, the down payment has to be higher, like 25% to 40%. But if it is residential, just 10 to 20%, because you are the one who will be living there. So you don't have anyone else paying the rent for you. So vary across countries. In that case, you have to do own research as well. Mortgages are available to suit various financial situations, but all involve the use of the purchased property as collateral for the loan. In the case of collateral, it's like a guarantee. You need to provide a security, something valuable, something which can be like an asset. It can be you maybe vehicles, whatever you have, which is private or business assets, equipments. Then there will be like maybe account as well, debt, like creditors, something like that. They have to provide to lenders or creditors at the bank. Then they will trust you with a mortgage or any type of loan, or business loan, which is different from student loans. So it is important to understand the local mortgage market and ensure that you loan terms align with your financial capacity and goals as well. So you have to understand the financial capacity, how much you own, and the goals as well. So if you want to buy a home through mortgage, through loan, which is like a loan, you have to understand yourself if you have some type of income, which is financial capacity. So you need to have a continuous income really to cover really the monthly installment or the monthly payment. You have to understand your goals as well in 20 years, 15 years, where do you see yourself? So thank you, ladies and gentlemen, just as we started. Thank you for watching. Don't forget to like, comment, subscribe, and keep sharing for more financial tips like this. And go to my YouTube channel, watch on the student loans versus business loans, watch the financial freedom videos. I've put a playlist as well on the business plan workbook and all the investment for beginners as well. Thank you for watching, ladies and gentlemen. Have a great day. Ciao. Bye.